Hi, so we will be doing a short fundamental analysis of Intel. He jumped currently 10%. He's after a huge drop in stock price. If you look here at the price chart, you can see a huge drop. Maybe let's go like this. Yeah, as you can see, the price went all the way from 60 to now $22 per share. And yeah, if we look at the revenues, we can also see a drop from 80 to 50, but 10-year revenue is growing 4.7%, but in the recent 5 years, the average drop is minus 2.5%. The earnings dropped even more, as you can see here, a huge drop in earnings after 2021, so the beginning of 2022, 2023, and now only the estimates are showing comeback, but it's not as rapid, nowhere near as rapid as the drop in earnings. The dividends were also cut 90%. The book value is less than 1, but there are stories that this book value is overblown. I mean, stories. If you look at the balance sheet closely, how do they account for stuff? It's not looking amazing, but still, if it's right now 0.7, then let's say 30% of that is shit, so it's around 1 in reality. It's still very nice. Revenue per share, maybe I will put on the chart so you can see this is the revenue per share, 20 years, so it's growing. Here is earnings per share, as you can see, also growing, then a recent drop. What else? Dividend per share, yeah, also a massive drop, but before the drop it was around 1.5. Oh, my bad. Book value per share also stably growing. There is a, yeah, it's growing quite rapidly, 8% growth. That's nice. Margins, return on assets, usually around 10 and 20, but has short times when it drops in 2009 and in 2017, and also recently it dropped for a longer period of time. If we look at net margins, they look like this. Also an instability in the most recent quarters. Operating margin looks even better, only one massive drop in 2009 and recently. So it's not a likely event for Intel to show something like this. Debt to assets, so 0.25, not a lot. What else do we have here? Equity to assets, 0.5. That's how the charts look. Gross margin, usually around 60-55. Wow, that's a great gross margin. And net margin much lower, between 15 and all the way up to 30. Still nice. And yeah, look at this. Currently stock price is 20 and the EPS in 2012 were 0.5. That's where the price is currently, at those levels. And yeah, the EPS was as high as 2, but in this range it's from 1 to 1.5. So there's a twice or thrice I don't know if there's a word like that, but double or triple if we see a comeback to most recent earnings power, but hopefully the buildings of additional factories will let Intel generate more revenues, more earnings. And also let's remember that Intel is now cooperating with Taiwan Semiconductors, so they will have access to the chip in terms of low price components. Okay, cash and cash equivalents, they shouldn't have a lot of it. It's not percentage wise or anything like that, so never mind. Goodwill, this is interesting. Goodwill is 27. And if we look at total assets, it's around 200. So 27, that's like 15% around. So 15% of all assets is in goodwill. And you need to remember that 81% is liabilities. So in reality, there is 110, I think, of like book value. And then out of that, 27, yeah, 27 is in goodwill. But of course, the assets that they own with debt are real assets. So, you know, book value, assets, goodwill, it's all intertwined. You can look at it from both perspectives. Okay, let's look at the long-term debt. 46. And current liabilities is 30. So out of the 81 in debt, 30 is from current liabilities and majority of it 50 long-term debt. But we'll of course have to check what is the rate of interest on that debt. So let's look at all of the indicators that have that. So for instance, total debt per share 11, effective interest rate on debt. Okay, effective interest rate on debt is around 2%, 1%. Bro, they should get more in debt. They don't have any debt problems. This company, in my opinion, is very good. With the huge drop and fear that I talk about in the other episodes, that is overblown, bro. I like this. Okay, let's look at the cash flow statement. Net income from continuing operations. Depreciations. Cash flow from operations. Cash flow from investing. Purchase of investment. Looks weird. So in here, purchase of business, not a lot, but look, purchase of property, plant or equipment. Yeah, they are building factories, etc. So this is nice. I like to see that in a company, especially a company that looks cheap to me. Sadly, I don't have any more free cash to invest, but hopefully you can. I own a position, but I would like to increase it, but I'm quite happy with the amount of funds I have in it. It's not like the rest of the money is sitting in something bad. Right, yeah, and the PE ratios, you can see a huge spike here to 125. Oh shit. This is not a financial advice, this is just my opinion. You should not buy anything, okay? It's illegal for me to say that, fuck. Okay, I will have to cut it out. I think that's the easiest way to do it. Alright, so price to sales ratios, all of those ratios We kind of already talked about. Nothing very interesting here. The huge cut in dividend also probably scaring away the dividend investors, which is good. And from the bad side, well, the Taiwan Semiconductor is probably one of the best companies, but it has some problems, like where it is that it's in Taiwan. There are some pressures, political pressures, and Intel is just really cheap in my opinion currently. It's a good price to buy in, and of course this is just my opinion, not a financial advice. All right, we have it current ratio and quick ratios. They are also very important liquidity indicators. Basically, you want it, if there is some problem with the company, you want to make sure that the current ratio is above 1. But sometimes, like with real estate, for instance, the current ratio is quite fake, because they can put, at least in Poland, the real estate as inventory, which is calculated, I think, into the current ratio. So you should also look at the quick ratio that doesn't have the inventory in it. And as you can see, it's clearly above 1. It's 1.15. This is what I like. I don't want it to be like 3 or 4 or 5. I want them to have a good financial strength, but without being more defensive. Like, I like some debt, not a lot of debt. I think there is, like, you can take some leverage when you should take some leverage, when you can take some leverage. For instance, when you pay very little interest, you should take that debt, and that's a good debt, because you can earn money on that, and you are not increasing your risk greatly. Of course, and very low interest coverage, but as you can see on the balance sheet, they have cash and cash equivalents, current assets compared to current liabilities. Total current liabilities is 28, and current assets is 43. So it's more. And look, just cash and cash equivalents is 25, so it's quite secure. Just this small analysis, I can see that there is a lot of cash. And yeah, it of course depends what type of cash securities are those, because they can also move in price, but I think that they are accounting for that every quarter, so you got the updated real value for that quarter for this their position, for instance, in a bond or any other cash instrument. And yeah, they have also a lot of inventories. We can look for inventories. There's this indicator that shows you how quickly days inventory. I think that's it. So I'm not 100% sure, but I think this is that it takes them 136 days to get rid of their inventory. So when they get a new one, it takes them that much to sell it. I will make a pause and double check. Exactly. So it takes them 136 days to sell everything. So that is also generating new money coming in. But of course, all of that inventory won't be changed into clean profit, but around gross margins around, I think, 60%, something like this, net margins around 30%. So still it will generate a nice amount of profits from that. Okay, I'm quite tired right now, and I know it's not too good to talk about those numbers too much, because it can be quite tiring, but I think I got some of the top important ones, and we looked especially at the debt of Intel, and is this what is the risk connected to this investment. I like to always remember about looking at the other side. So of course I'm bullish on this investment. I think it's a nice place to get in, although I think the better place was at $20 per share. But of course, this difference is nothing. Just 10% from 20 to 22. It's not changing quite a lot. So I will probably buy a little bit more later. We'll see. And yeah, this small movement from 2019 to 22 for a value investor shouldn't be any indicator of any changing. A change of 10% is not going to change your outlook on a long-term investment. In here, I'm looking for a much greater increase in the share price connected to the comeback of earnings, and hopefully we'll see the market looking at this instrument, at this stock, because the market, when the sentiment changes, the market will price in the optimistic future, and hopefully we'll be able to make our money quicker than the earnings in reality will come back, because we'll see the sentiment change. But of course I can hope for that, but market works quite randomly. So if we see a quick move up, I will be happy. But if we see a move even lower, let's say we drop to 15, bro, I will sell some of my other investment to buy this one. If we see a drop to 10, I would be much happy. Of course, if the situation changes, and that's why we see the drop that is corresponding to the reality of the loss for the real value of the company, not the stock price. So if the real business has some problems and we see the drop, of course I wouldn't be so optimistic, because maybe it's, the company really lost 25% of the value. That's why we dropped from $20 to $15. But short-term movements are usually random, based on some fear. There are thousands of reasons why it can move. But yeah, when it goes up, that's good. When it goes down, that's also good. On the stock market, you just make money. Of course, it's not that simple, but if you have the right mindset, it becomes easier. But still, this is very shocking, but still, you know how to behave, but your subconscious can give you some emotions, fear, etc. You can still feel fear and know that you have to buy at the same time during crashes, for instance. So that's a good mindset to have, to remember that the real value of the company and the stock price is not really the same thing. All right, if you enjoyed this podcast, remember to, rate this show. You can if you want, you don't have to. Of course, you can follow. I don't really care. If you want to follow, then follow. And yeah, if you want a hoodie, there are hoodies. You can get one of those, or a t-shirt. And yeah, I hope you have a great day. Bye bye.